Hey, everybody. Welcome back to the Healthy, Wealthy, and Smart podcast. I am your host, Karen Litzy, owner of Karen Litzy Physical Therapy, located in New York City. And today we are talking about student loans. I'm happy to have back on the program, friend of the program, Joe Reinke. He is a CFA charter holder, founder of FitBux, adjunct professor at 15 universities. In short, he is a financial expert and also a fellow Jane ambassador, Jane, the wonderful EMR that we use. So, Joe, welcome back to the podcast. Happy to talk about student loans and what changes are happening as a result of the latest big beautiful bill or whatever the heck they're calling it. So thank you so much for coming back and sharing your knowledge with all of us.
Yeah, glad to be here. And I'm always, talking about student loans. So I'll throw something positive in there before
Yes.
student loans. The stock market's at an all-time high again. So yay. Like, so I just feel every time we come on, we're talking about, like the everybody's favorite topic, student loans.
Right.
So had to throw that one in there that,
Right.
we got something good going on. So
Well, that's a positive. That's a positive. So now let's get into, and I'm not saying this is a positive or a negative, but let's get into student loan changes. You can let us know what the dates of these changes are, what some of the changes are going to be, and how that affects people in a very practical way. So I'm just going to toss the ball over to you.
yeah, so and the way you can think about this is people are getting affected in basically three different categories. There's those that are students or going to be students. Okay. There are those that are already in repayment. And then there's those that are going to be entering repayment after July 1st of 2026. Okay. So there's basically three groups. The middle group, the ones that are in repayment right now, are the ones that are everybody's like, I don't want to say freaking out, but they're like panicking because it's like we got to choose something because if they don't choose something now, those choices are going to be gone by July 1st. I shouldn't say by July 1st of next year, by July 1st of 2028, but that date might be moved forward. Okay. And so I'll start with the easiest ones first. We'll start with like people that are in school. Okay. Because this is the easiest, but it also has a major impact on just industries, especially the DPT,
Mhm.
because graduate programs are going to be affected. So right now, the current system, you can get federal student loans up to whatever your program says is the cost of tuition, cost of attendance, and cost of living. Okay. So basically, and most schools way overestimate cost of living. So basically, that means 100% financing. Okay. That is going away. So if a student starts school after July 1st of next year, then the cap that they're going to be able to get for like undergrad and master's programs is $100,000 and $25,000 per year.
So
Okay.
a
And then
$100,000 total.
total federal student
Okay.
loans. And if it's for a professional program, which they haven't defined yet, we believe it's going to include DPT. Okay. Like because of the way they've defined it in the past. But things like MDs, DPTs, they're going to be able to get a total of $200,000 for that's combined undergrad and grad school, and capped out at $50,000 a year. And so the reality of it is that, people are going to end up having private loans again, and it's going to be more like a system like we had prior to 2008, where just to give you guys some statistics about going into 2008, 2009, because that's when they changed the loans to direct loans. Like the government basically took over the loans. It was about 50-50, 50% federal, 50% private. And then now it's like 94% federal, 6% private.
Mhm.
It's going to shift back just because of the way it is. It might not be 50-50. It still might be like 60% like federal, 70% federal, but there's going to be more of a private industry there. Uh, so that's what's going on with in-school stuff. I know a lot of programs are starting to freak out because a lot of their grants and stuff have been hit,
Mhm.
but they're also saying how is this going to affect enrollment? Which enrollment's actually already been down across the board for graduate programs, so this might just increase it. Um, Maybe put some pressure on tuition rates. I don't know.
Right. Yeah.
Time will tell.
TBD. Now,
Yeah.
can you explain what is the difference between a federal loan and a private loan, and how might that affect the borrower? after they graduate?
Yeah, so a federal loan is backed by the government, and there's a lot more leniency there. There's 3 times you can go on forbearance, for example, for 18 months in case you can't make payments. But most importantly, from a repayment perspective, you qualify for income-driven repayment plans, where your payments are based as a percentage of your income, and they also qualify for public service loan forgiveness, which there's a ruling that came out this morning. We'll touch on that too. Um, but it qualifies for public service loan forgiveness. When you're a private loan, you don't qualify. Like you're paying them off. And so what we could see end up happening is where, let's just say a student has $225,000 in federal student loans, they can go on to things like loan forgiveness and be okay. Whereas if they were having that split, say it's like 100 grand federal and 100 grand private, chances are you're gonna have to pay off both of those now. Because even though you might qualify for forgiveness on federal, it's only $100,000. So over time, your payments are going to be at a point where you're paying it off anyway. Um, and so we see, and we've seen this before, by the way. So there's been like PT programs, for example, that are getting accredited. So borrowers can't get all the federal student loans, so they end up graduating with half and half.
Mm-hmm.
And they can pay it off, but it's a struggle. And so that's where I see, some issues coming up in 3, 4, 5 years for even DPTs. Because let's just say you go to undergrad and you have, 100 grand in loans already. You can only take out another 100 grand and you can only take out 50 grand per year. So some of the programs, I know like a couple of the programs, like Karen, you might throw up when you hear this. Like one of the programs caught just by intuition by itself is $180,000.
For
So
the
it's like
full three
for the
years?
full 3 years,
Uh-huh.
correct? And so it's like, well, if that student has, 100 grand from undergrad,
Can't do it.
like they can only take out another 100 grand. Like they're gonna have probably 150 in private student loans as well.
Mm-hmm.
So you're gonna have 200 grand in federal, like 150 grand in private,
It's too much.
right? So, and that's why I was saying hopefully it puts a little bit of pressure on like tuition rates and everything. I doubt that
Mm-hmm.
it will, but we'll see.
Yeah, yeah. I had this conversation with a professor last week about, well, do you think now that they've capped loans, will it force universities to drop their prices? And he said, well, it better, but to your point, TBD.
Yeah.
Time will tell. Um, but they're at any rate, that's a whole other conversation on tuition costs and why they're so high, et cetera, et cetera. So we will leave that for another time. Um,
Mhm.
so if you're a student now, for all of undergrad, you can take out $100,000 for that's 4 years of undergraduate studies, or three, however long it takes you to get through your undergraduate
And
studies.
and for master's programs. So like if you have your
Oh,
undergrad and your MBA, the most you can take out is 100 grand.
oh my. Okay. All right.
Hmm.
And then so you go through your 4 years of college, you had to take out 100 grand, right? So now you're applying to physical therapy school and you can now take out a maximum
Of another 100.
of
So
another 100.
they have two different like labels, like your undergrad and master's programs, and then professional programs. If you go to a
Okay.
professional program, the combined can be 200,000.
I see.
If it's just undergrad and grad school through like a master's, it's only
A hundred
a
thousand.
hundred. And that's why there's other industries out there. So like PA, NP, those are not considered in the past, those have not been considered professional programs. Those are considered master's programs. So
I see.
they're not getting funding. That's what the industry is believing. SLPs may get funding, like up in the air because one's an MOT, one's a OTD. So like, what are we doing there? And so
Mm-hmm.
in the past, the way they've classified them is how long you're in school. So like if I started school as an undergrad to completion to get my license, is it a 6 year program? So
Mm-hmm.
and DPTs, that's what it is. It's if your traditional route, it's 4 years for undergrad, 3 years for your DPT. That's
Mm-hmm.
seven, that's more than six, and there's a license at the end of it. Like that's good. But like PA stuff, that's not the case. It's only 18 months.
Oh,
Sorry. Like,
Oh, so
so
they would not be able to take out the loan for a professional program.
correct,
I see. So they just have that
correct,
100,000
correct.
and
And
they got to make it work.
that's the way a lot of the people in the student loan industry that I've talked to are interpreting it. They haven't come out with
Hmm.
the official announcement yet, but that's the big wild card right now. And I know that's why a lot of programs and health science departments that I work with, like, they're freaking out because they don't
Sure.
know what's going to happen there yet.
And to be clear, that's 100,000 from the federal side. Anything
Correct.
above that, you would have to go to a private
Private.
institution like a bank.
Like a Sally Mae, a College Ave, a Linkey,
Okay.
SoFi, like those private lenders that have private student loans.
Right. And so if you have those private student loans and you lose your job, you can't go on forbearance, put them on hold. You have to keep paying them. Is the
Yeah,
interest higher in private loans than it is in the federal loans?
typically, yeah, they're a
Mm-hmm.
little bit higher.
Mm-hmm.
They do have some forbearance stuff, like some of them will let you forbear for 6 months, but they're a lot more strict there. You actually have to show that you got terminated. Like,
Mm-hmm.
there's very strict things you got to follow versus just the government. You're like, put me on forbearance, and they're like, okay. Like,
Got it.
so yeah, it's a little bit more strict on that.
Okay. All right. Well, that's a really good overview of what happens if you're a student or you're
Mhm.
going to be a student. So, how about those folks who are currently in repayment? I know there are people that graduated around the time I graduated that are still in repayment. And there are people, obviously, who graduate in the last 10, 20 years who are in repayment. So, what happens to their choices when it comes to their
Yes.
student loans?
So when you look at student loans right now, the actual loan forgiveness plans that are available, you have ICR, which basically nobody goes on, which it's don't even need to be talking about it. Then you have pay as you earn, PAYE, and then you have save, which is basically already gone, it's being challenged in court. And then you have this thing called IBR, income-based repayment. And people get confused with income-based repayment for two reasons. One, you have old IBR and you have new IBR.
Of course.
Okay. Like, let's make it confusing, right? Old
Yeah.
IBR is for people that had loans prior to January 2014. Before that, or July 2, they had July 1st, 2014. New IBRs after that date. Okay,
Okay.
that's how they do the cutoff. Now, where the second piece they get confused on is pay as you earn is exactly the same thing as new IBR in terms of how they calculate it and everything else. Okay, eligibility is a little bit different, but at the actual repayment plan is exactly the same. Okay, so when I say things like new IBR, I use new IBR and pay as you earn interchangeably.
Okay.
Just okay. So what's happened with the OBBB, whatever they called it, what that's doing is it's getting rid of save and pay as you earn and ICR.
So three of those are gone.
They're gone.
Okay.
And the reason being is because all those programs were passed by presidential action, not by Congress.
Okay.
So the only ones that were passed by Congress were IBR, income-based repayment.
Okay.
And so they've told everybody that is in repayment right now that you're going to have to choose one of those programs if you want to stay on it. And the deadline is July 1st, 2028, which is the deadline in the bill, but it says that the Department of Education has to have everybody switched by that date. So the Department of Education can come back and say, you got to be on this by July 1st of next year. Choose.
Mm-hmm.
Like, they just have that deadline of 3 years. Like, the Department of Education has that deadline, but they can do it anytime sooner that they want to.
Got it.
Okay, so a lot of people are like freaking out because it's like, well, am I going to miss the deadline? It's like, we don't know because we don't know when that deadline is yet.
Right.
Um, but that's the big thing there. And for a lot of times, up until August 1st, a lot of people were not doing anything because they were on save forbearance and it wasn't accruing interest. That stopped August 1st. And so there's like for about 90% of people, there's no reason to stay on forbearance anymore because you're accruing interest and you're not getting any credit towards forgiveness. So it's like get on a plan so you can start getting
So you could
like,
start paying into it, paying off that
hmm
interest. Yeah.
and those months start counting towards forgiveness. Like you gotta go. Like,
Right.
so yeah, the last like 2, 3, 4 weeks, I mean, we've had probably over almost 1,500 phone calls just because of that. People needing to make the
Mm-hmm.
decision. Um, and to make it even more confusing is a lot of people, they haven't made a switch over in the programs yet for the government, like on their site. So people can still qualify for pay as you earn, even though it's going to go away. And so right now, if you're kind of contemplating which plan to go on, if you can get on new IBR, which is 10% of your income, that's the one to go on because that's not going anywhere. That's the cheapest. If you can get on it, get on it. Um, if you're like an older borrower, if you can get on pay as you earn for the next year, fantastic. But chances are you're going to go to old IBR. Like,
So
you
what's the
just
difference
switch over
between,
that.
so what are the choices, just two choices, old
Pretty,
IBR, new IBR?
pretty much. Or like,
What's the difference?
so new IBR is 20 years long and 10% of your income.
Okay.
Old IBR is 25 years and 15% of your income.
Oh, well, new IBR definitely sounds better.
Oh yeah.
So
It's a
if
lot
you're
cheaper.
got it. So if you're an older borrower, let's say you graduated in 2000 from physical therapy school, you would be considered in, maybe you were on
You
old
go,
IBR. So
correct.
you can make the switch from old IBR to new IBR.
You can't. And
Oh, you can't.
that's where it's a lot of people make a mistake because
Okay.
the loan servicers, and they're right, they'll tell you this, like you can consolidate your loans and then go into new IBR because when you consolidate your loans, it's considered a brand new loan. The problem is it's considered a brand new loan. So like let's just say you have 15 years of payments and you have 10 more years on old IBR, you consolidate, that clock starts all over again.
So
You got
now
another
you're at
10
20
years.
years.
Hmm.
Oh, man. Oh, that
And so,
is a
uh,
conundrum, isn't it?
yeah. And so it's a double whammy too, what we're seeing right now. This is like a new phenomenon we've been seeing in the last like month, is that people are going to be on that plan, which a lot of them were already on that plan anyways. Like, so they understood that payment. But what has happened, like when you ran projections 10, 15 years ago, you might say, hey, look, a normalized income increase is 3%. So this is what's going to happen over time. Well, because of inflation over the last 4 or 5 years, we've been seeing people, especially in the hospital systems, getting raises of 5 or 10%. So their incomes have increased. Their cost of living, though, has increased to more. So their salary is not keeping up with cost of income. So their overall money coming home is already tight. But because of that extra bump in salary increases, it's also increasing their student loan payment. So they're getting hit with a double whammy where, like, if inflation wouldn't have happened, they probably would have been fine. But because of inflation happening, their cost of living is going up so much and their student loan payments going up. It's like, oh crap, like, how am I supposed to do this?
Right.
That's why we've had probably like 5 to 10% of people that we work with. Um, they're like, I have to stay on forbearance because I got to figure out how the hell, like between my mortgage and everything, like I did not plan for this payment going up this much. I got to figure out where I need to shift my finances, and I need 6 to 12 months to figure this out. Like, they're panicking because it's like, what do you cut? Like you can't cut
Right.
food, you got to eat. Like, so
Right, right. And most people can't cut a car payment or car insurance. If you live in a place where you need a car, that's kind of important.
yeah, yeah. And I mean, car insurance, like I mean, I just, for example, got a rude awakening. I mean, my car insurance just went to go renew and they doubled it. And I'm like, no, no, no. Like I went out and shopped and I got it back lowered, but I was like, this is not being doubled for no reason. They're like inflation. It's like, that's bullshit. Like I'm not paying this.
Hmm.
But it's a real thing. And that's to me, a lot of people are saying, oh, the student loans are the big problem right now. It's like, no, 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 you're seeing the repercussions of inflation. Like this is the
Right,
reality of it.
right. And also for those people who, let's say, weren't making regular payments because with COVID, everything was kind of put on hold. Am I right in that?
Yep.
Okay. So what does that do to people's budgeting, I guess? You really have to make some decisions, right?
Well, it's a massive shock on two fronts. One, I mean, we know people that have $0 payments for the last 5 years just because of the way things happen.
Hmm.
We've seen other people that they might have got it approved like the year that they graduated. So their payments were like $100 a month because they only were only qualifying on partial income because they didn't work the whole year. And so now that they have a full year's income, that's going to spike to $600 or $700, and that's going to be the normal payment. That's what it was supposed to be all the time. It's just when you originally qualified, you did so with partial income. So now it's going up to normal. And so that's where, you see a lot of these stories on like Facebook or Instagram or Reddit, and they're like, my payment was, $200 a month, and now it's 600. It's like, well, that's why it's going to a normalized payment. And it's not so much
Right.
because of the repayment plans. The repayment plans is maybe $100 to $200 for most people. It's not earth shattering. It's because of people's income changing. That's been the big,
Right.
big hitter on all that stuff.
Got it. Got it. So for people, just to recap this new and old, for people on the old IBR, can kind of have to stay on that old IBR. Otherwise, they'd have to consolidate their loans, which would be a new loan. Then they have to go on the new IBR, which starts at day zero. So you still have 20 years. So if you've been
Correct.
paying, so if you graduated in 2000 and you've been paying your loans, well, let's see, you didn't have to pay for 5 years. Let's say you're 20 years, you want to kind of stick to where you are because maybe you only have 5 years left. Is that
Correct.
right?
Correct.
Okay.
Correct.
And then the new IBR are for who?
People that did not have a loan prior to July 1st, 2014.
Okay. Okay. So if you graduated physical therapy school in 2016,
If those were your first loans, yeah. If you had undergrad loans before that, then it's still old IBR. So
okay.
all your loans would have had to be new after July 1st, 2014.
Okay, that's a good distinction. Thanks for that.
Mhm.
So that's undergrad and physical therapy school. So all of that had to be after 2014. I bet
Correct.
that's confusing too for people.
Yeah, and the even more confusing part is that we know people that had loans before that. When they go on right now to studentaid.gov, it's saying that they qualify for like new IBR, even though they shouldn't. And I'm like, great, go on it. And if they want to make the mistake and not catch it, great.
Mm-hmm.
Like, go on new IBR. Like, they're
Right.
like, should we tell them? It's like, no, like,
Right.
go on, take advantage of it.
Right. Right. And the
So,
new IBR is 10% of income. Old IBR is 15% of income.
hmm
Okay.
exactly.
New IBR is 20 years, old IBR is 25 years. But if you
Yep.
on old IBR, you're probably maybe fairly close of reaching that 25 years versus going back to
Correct.
20.
Correct.
Okay.
Correct.
Got it.
And that's the big dilemma right now is because people are like, well, I still have 10 more years left. But for a lot of people, the payments are so high, it's like, do I just turn around and pay this off instead of go for loan forgiveness now? So that's the other part that they're trying to contemplate is I'm not really going to get anything forgiven anymore. Like, why stay
Right.
on it? And
Right.
now they got accrued interest and they got to pay that back. So it's, just getting hit with the double whammy on that.
Right. Right. So people who are on the old IBR, by the time they finish, they wouldn't get any forgiveness anyway,
Or it might be
or
very
very
little.
little.
Correct.
Right. And
Correct.
when you do reach that 25 years on old or 20 years on new, and let's say you have $50,000 left on the loan, that loan is forgiven, but you still have to pay taxes on it.
Correct.
Right. So you have to remember to put that money aside. So you need to kind of have people like you who can do that calculation for you and say, at the end of this loan, this 20 years at 10% of your income, depending on, you can probably do some projections to see maybe where the income might be. Make sure you're putting away this much money every year so that when the
hmm
time comes, you're like, wait a second, I don't have money to pay the taxes on that 50, 60, 70, $80,000.
Correct. And now you do have it. So that's one of the big things when we're building out financial plans that we're looking at is how much do you need to save for this tax
Yeah.
and
Yeah.
how are you gearing up for that. So yeah, and so that's old IBR and new IBR. And then the new one, it's got some good features on it. Before I dive into the new one, any questions on all that?
No,
Because you got it down pretty good because it's
I
it's
think
pretty
I
damn
got it.
confusing.
I was
Like,
taking, I was sitting here taking notes and being like, okay, I get this. I think I got it. I got it. I'm much
yeah.
more confident in it now.
And if you're listening to this, you might have to like in your car, you might have to pull over and take some notes on it because those
keep,
dates and those
keep
numbers, it's
rewinding.
confusing. Yeah,
Right.
and,
And
and people are
also
like,
the hard part too is like, there is no solid date. Like you said, it could be July 1st, 2028, but it could be 2026. Who
Yeah,
knows?
we don't know yet.
We don't
So
know.
the one date we do know is July 1st of next year. That's when the new income driven repayment plan is coming out.
Okay.
Okay, that is the one date that we do know. It's called RAP. It's RAP, or the Repayment Assistance Plan.
Okay.
Okay. Now this is very similar. It's based as a percentage of your income on your
Uh-huh.
monthly payments, but it's different because it's a tiered percentage. So it's not a flat 10%. It's based on your adjusted gross income. So, for example, like if you make between 20 and $30,000 a year, it's 2% of that number.
Okay.
Okay. And then it tiers up for every 10,000. So it goes 3%, 4%, 5%. Once you hit 100,000, it's 10% of your income and it's capped at 10%. It doesn't go
Okay.
up anymore from there. Okay. So
Okay.
that's a little bit different of a feature, which makes it like when you're lower income, it makes it more affordable than some of the current plans and so on and so forth. And so that's a decent feature. Now, on top of that, there's interest forgiveness every month, interest subsidies. So when your payment doesn't cover your interest, instead of the loan balance increasing, the government's going to forgive that interest immediately. You don't pay any taxes on it or anything. So on the new plan, your balance never goes up. Okay. In addition, your balance, the government also provides a $50 match towards your principal. So every month, if you have a normal payment of like $400 a month and it only covers interest, the government will reduce your principal by $50 a month as well.
Okay.
So those are pretty good features. So when people are actually like looking at this, they're like, what's the downside, right? Because if you look at the monthly payment, it's going to be cheaper than old IBR. And people on old IBR can go to the new plan and they don't lose payment history. It's going to keep going.
Okay. So if you're on old IBR, sit tight until July
Maybe,
1st, maybe. Of
maybe
course,
because there's a
maybe. We'll see what
curveball, right?
happens. Of course.
Because everything in this plan sounds great, but
Yeah.
it's also 30 years long, not 20 or 25 years.
Oh, okay.
Okay.
So
And
so once you so for a lot of people, they may completely pay off that loan in 30 years and there's really not much to forgive. Is that the deal?
that's what it's going to be. And
Yeah.
I can see somebody asked me about some stats the other day. I could say that probably 70, 80% of people are going to end up saying, I just want to pay off my loans instead of going on this. And that's what it's going to be.
Hmm.
Um, Except for if they're at a nonprofit, because if I'm on old IBR and I got 2 or 3 years left until I get my loans forgiven for PSLF, then I can go on RAP and the monthly payment's lower, and I don't care about the 30 years because I get public service loan forgiveness. So if you're on public service loan forgiveness, it may be a really good plan to go on because the
Hmm.
payments are cheaper. But that's why I was saying for the people that are in repayment right now, if you can get on old IBR, it's way better, or new IBR, I'm sorry, new IBR. If you can get on new IBR, it's way better than old IBR and it's way better than RAP. Like there's no question. That's where you're going.
Okay.
If you're stuck on old IBR, then that's where the question mark comes in is do I stay there? Do I go on RAP or do I just say, nah, screw this, I'm going to pay off my loans? Okay. Now, if you're not in repayment already and you graduate and your repayment does not start until after July of next year, you don't have a choice. It's either RAP or the standard plan. There is no more choice.
Oh, what's the standard plan?
So the standard plans are going to change too. So right now, the standard plan is 10 years. That's just a regular 10-year. Like if you have a car loan and it's a 5-year car loan, you make the payments, it's gone in 5 years. That's the standard plan. The standard plans are changing to say if you owe less than 25 grand, it's 10 years. If it's 25 to 50 grand, it's a 15-year loan. If it's 50 to 100 grand, then it's a 20-year loan. And if you owe over 100 grand, it's 25 years. Now, of course, you can always make prepayments. Like you can be on the 25-year plan and pay it off in 5 if you want. Like
And so
that's
with a
fine.
standard plan, you're just paying off the whole loan.
Correct. The balance goes to zero. When it hits zero, the loan's gone.
That's that's what I was at because I when
Mhm.
I saved my letter that said you have a zero balance.
Yeah. And so that's what you've done was a standard plan. These
Yeah.
other ones that we're talking about are the income driven repayment plans, which most of the
Right.
time somebody's going to go for loan forgiveness. But to your point that you made earlier, especially on the new RAP plan, people are going to have basically nothing or very little forgiven, especially in the healthcare industry. The only way that's if you work the entire 30 years. The only way we can see that not happening is like if you stay at home part of the time or whatever it is, like then yeah, maybe you still might have some stuff forgiven. But for when we run scenarios for people, because we have, even though you can't go on the wrap until next year, we already have it in our technology. So when we run it, that's what we're seeing is, for most people, you're better off just paying it off and saying, hey, how fast can I pay this off? What does it look like?
Mm-hmm.
So, but in a nutshell, that's all the new fun stuff coming out. There was a PSLF announcement today that the Department of Education is going to try to change some stuff on who qualifies. I would not put a lot of stock into that. I can see them doing that, and then I can see it being immediately challenged in court and it getting
Mm-hmm.
thrown out in court.
Right.
So right now, you guys have probably seen headlines. Some of you might have saw headlines yesterday and today about that. I wouldn't get too worried about it right now. Even if they do put it into law coming up soon, it's going to get challenged pretty damn quickly. So,
Right. And that's for like if you're working at a non-for-profit, so a hospital. So could you just explain my understanding of it? I'll give you my understanding and you let me know if I'm right or wrong. So
yeah, go
my
for it. Let's do it.
understanding is if you work for a non-for-profit, like a hospital or something like that, and you have to make your payments every single month, never miss a payment. After 10 years, the loan is forgiven, but you still have to pay the interest.
No, it's gone. Everything's
It's gone.
gone.
Oh, everything's
Everything.
gone.
No
Not even
tax, no
interest.
interest,
Okay.
nothing. It's just
Okay.
gone.
Okay.
So what's happening right now with this new stuff on public service loan forgiveness is they've come out and they've said if the program, if the nonprofit does anything that is illegal or can be contrived of illegal activity, all the employees don't qualify.
What is an illegal activity?
So that's the problem. They're not really saying what that is. What they've said from a
Shocking.
high level, for example, is like if in your state and at the federal level, if it's deemed illegal to do uh any type of trans treatment for a minor, that is illegal. Everybody that works for the hospital doesn't get public service loan forgiveness. Period. If you are at a university that, or here's the big one. This was the one that we saw that actually I just read before I got on here is the government, if your city, so like if you live in Boston or you live in New York and your mayor and your guys, the people that run the city have announced that it's a sanctuary city and they're housing illegal immigrants, that is against federal law. That's anybody that works for that government no longer gets public service loan forgiveness, like because they're engaged in illegal activities. And so that's it's like, depending on which side you're on, it's like, well, that's good, that's bad. I don't even care about that part of it. I care about the legal part because when PSLF was passed, which a lot of people don't realize this, it was bipartisan, but Republicans were in office when that passed. Like they champion public service loan forgiveness. Like it's not going anywhere by law. Um, but what ended up happening was that it's very explicit in the law that Congress passed that it's all 50c31 companies. They don't say if you do this, it's illegal. Like it's not up to the administration to add that part in. So just like when President Biden did all this stuff with SAVE and all these different things, and that got challenged in court because it wasn't done by Congress. And we just talked about earlier about pay as you earn being gone and SAVE being gone. It's gone because it wasn't done by Congress. So all this stuff with PSLF, it's not done by Congress. So I could see the courts immediately just being like, nope. Like Congress said this. If you want this changed, it's got to go through Congress. And if they were going to do anything to it, they would have done it probably with this last bill.
Mm-hmm.
Like they would have changed something. So to me, like when I hear, the administration talking about this stuff, it's just talking points. They probably know they're never going to get anything done, but it's just to say, look, we're trying to do what we said we were going to do.
Mm-hmm.
Um, and that's it. I don't really see it coming down and changing anytime soon.
Right, right. Well, that's good because boy, oh boy, that would be a revolt in the streets, I think. Um,
Yeah. Yeah.
and it would I would assume, just discourage people from working in underserved areas, in rural areas, and things like that, where people really need medical care because it is in very short supply.
Yeah, and the reason why, by the way, I said that this is like it has bipartisan support is so the big thing that when you talk to a lot of Republicans, what they were really upset on public service loan forgiveness was you're right. They set up that program for like rural areas and mostly nonprofits that had lower pay. But what's happening is that you had like MDs that would go through residencies and fellowships. And all that time, those 5 years would count towards public service loan forgiveness. And then they would become an MD and they have a $500,000 salary and their loans are 300 grand, 400 grand, but they're getting them forgiven because all that time during residency. And they're like, wait a second, like these people can afford to pay these off. And so both Democrats and Republicans wanted to go after that. And in the big, beautiful bill, that was actually one of the things they changed was like residency no longer counts towards public service loan forgiveness. And then with the new RAP plan, it's not going to make any sense for an MD or a dentist or something like that to do that and try to go on forgiveness. They're going to have to pay back their loans. And so the target for both Democrats and Republicans on that part has already been quote unquote solved. So
Mm-hmm.
I don't see that was the only thing that I could see Republicans being like, we're going to change public service loan forgiveness. Well, they basically already did on that front. So I don't
Got
see
it.
it changing any other way.
Yeah, yeah. All right. Well, that's all really good. Very good info. So we covered students, we covered those in repayment, and we covered those who will be in repayment after July 1st. So the
Correct.
RAP plan is only for people who will start repayment after July 1st, 2026.
Correct.
Okay.
Unless you're an older borrower and you decide to switch
You want to
because
switch.
for whatever reason you think, and we've talked to maybe 3 or 4% of people that are going to be on old IBR, and it makes sense to switch to RAP when it comes out. Every single one of them are at a nonprofit going for public service loan forgiveness. So that's what I'm anticipating going forward as well.
Right, right. Okay, so what did we miss? Is that everything? Is there anything else that you feel like students or people who are graduating soon, those who are already in repayment, et cetera, is there anything we missed that you feel like is really important?
Yeah, I would say the last piece is, as I mentioned earlier, more people are going to be deciding to pay off their loans, which means looking into student loan refinancing and figuring out if you should do that or not and dropping your interest rates. And there's a lot of misconceptions like I have to refinance all my loans. No, you don't. Like some of the new grads are coming out with 8, 9% interest rates. You can refinance those higher interest rate ones, get them down to like 5 or 6% right now. And so, mix and match, make sure you're actually calculating how much you save. Like that's something that we do every day on the phone with people. Like, because like if you go to SoFi, their calculators are built for compliance, not actually to show you how much you actually save. So oftentimes when they show you the numbers, they're comparing apples to oranges situations. You got to be able to compare them apples to apples to figure out how much you're actually saving. And then when we get to that number, that's when you make the decision. And I'll give you an example. I was talking to a FitBux member the other day, and she's like, yeah, it makes no sense for me to do this. I'm going to end up paying off my loans really quickly. And so she's going to end up paying off her loans in about 1.5 or 2 years. And she could have refinanced her loans, but it was actually only going to save her because she's paying off her loan so fast. It was going to save like $200. So if I was showing her something like $15,000 in savings, it's like, no, because they're mapping this out over 10 years, not 2 years that you're actually going to pay this off.
Right.
And so she's like, well, it makes sense to just stay at my federal loans just in case something happens like COVID or something, right? I'm like, yeah, exactly. She's like, for $500, I'm not refinancing. But that's the type of calculations that you need to do to figure out, hey, what do I do there once I decide to pay it off?
Got it. Okay, well, I feel like I've learned a lot more. I've got my notes. I can't counsel anyone, but I can tell them where to go and they can go to you. So, where can people go to find more information about FitBux and you if they have questions, they want to
Mhm.
get their hands on these calculators?
Yeah, FitBux.com. It's full on financial planning, financial management for young professionals. We started it in the world of student loans and then built the technology around all that. So we're experts in student loans, but we do everything now, everything from investments to everything like buying homes and all that type of stuff. So it's FitBux.com. Everybody's like, financial planners are like 4 grand, 3 grand. It's like, no, it's 18.99 a month, like, because we use tech to supplement what we do. So it's a lot more efficient. So come on board, and if you do come on, we tell everybody, like, build your profile. You can use the technology on your own if you want to, but we highly encourage you to schedule a call. It's no extra cost. Like, get on a call with one of our experts. Make sure you get all your questions answered. Get the plan set up perfectly, so that way you're doing the right thing, and then go from there.
All right. So everyone, that's fitbux.com,
Yep.
FITBUX.com.
Hmm.
I know. Isn't that my first rodeo here? Um, so, I feel like I've asked you this question so many times as what advice you would give to your younger self. So what if we kind of switch it up a little bit? And you talk to a lot of physical therapists, right? So we're gonna do a little game here, a little back and forth based on Andy Cohen and Watch What Happens Live, where he has this thing like, do XYZ give a damn? So I'm gonna ask you, do physical therapists give a damn? And we'll just ask a couple of questions and you will say yes or you will say no. And if you want to say why, that's fine. Okay.
Let's do
So,
it.
so the first one's going to be, it's a softball. Do physical therapists give a damn about the new loan repayment rules?
They shouldn't. I mean, very little if they do. I mean, it does have an effect, but once you decide what it is and what you're doing, just how does it slot right into your overall financial plan, right? And we brought up the technology a few minutes ago in the service. That was the whole reason why I created it, because I didn't want this stuff stressing people out. And so when you set up the plan, and you're like, okay, I could slide this here, move this here. Yeah, you got to think about it for about 5 minutes, 10 minutes. But after that, you just go on with your life. So, stressing about it, it is what it is. Like, you can't do anything about it.
Got it. Got it. Okay. So, second one, this will be a little off topic, but do you think physical therapists give a damn about Taylor Swift's new album that just came out?
Absolutely not.
What?
I,
Disagree.
sorry, that is my bias coming in. I did not even know
What?
she had a new album. I can't even tell
What?
you. I can't even probably tell you if you could play a Taylor Swift song for me right now. I probably wouldn't even know that it was her. So, all I did is I just, yeah, I don't, yeah, I have nothing with Taylor Swift. I'm sorry.
All right.
I'm trying
Okay.
to I'm trying to keep my 8 year old away.
Oh,
I'm failing though, but
well, your 8-year old probably gives a damn. Okay. How about this? Do you think physical therapists give a damn about buying a new home?
yes, because
Or buying a home?
so this is my thing, because I look at this from a financial perspective. Okay,
Yes.
so I believe that over the years in the last century, the National Realtors Association and the financial industry and banks and even Congress have done an extremely good job of propagandizing buying a home, and that everybody needs to do it, and that's the American dream. And it's like, the American dream was owning your own property and being free. That's what a lot of the founding fathers said, but that wasn't necessarily American dream. American dream was people coming over here wanting to get away from tyranny and just having a chance. That doesn't necessarily mean owning your own property. And when you look at the mathematics behind it, owning your own property oftentimes is actually a waste of money. Not necessarily a waste, but the return is nowhere near what it would be if you just rented and invested in the stock market. And so it's one of those things where it's like, it's propaganda, but it's also part people saying that they want to, this is mine. And I get that. That's perfectly fine. Like, I own my own house. Like, it is what it is. Like, do I want to own it now? Probably not. Like, it's too much shit to take care of.
Hmm.
Um, but like, I believe the answer is yes, because just the outside influences
Right.
that people have, and oftentimes when people actually sit and really examine it, a lot of times they'll say no because it just doesn't make sense financially.
Right.
Um,
Right.
but
Yeah, Ramit Sethi is on
Mhm.
believes in that. Okay, so last question, pop culture again related.
Uh-oh,
So,
I
do you
failed
think
these ones.
physical? I know that's why I'm asking. I think it's so funny. Do you think physical therapists give a damn about Love Island season 7 reunion coming up with Amaya Papaya?
I can't even answer that because I don't even know what Love Island is.
That's why I asked.
I have no idea what that show like. People are like, what do you watch? Like here's some insight to me because I don't ever tell people this. Even my best friend was like, I had no idea that you like that. The only thing I ever watch is Star Wars. Like that
Okay,
that's
that's
all like
respectable.
yeah, when I was growing up, I've read like every Star Wars book you could possibly think of. Like even my best friend's like, I didn't even know you like Star Wars. I'm like, yeah, I just don't talk about it. Just why? Like, I'm not gonna make like small talk about some make believe fantasy land. Like, no, I like it. It's entertaining and like move on with my life. Like, but other than that, I don't. I can't tell you anything on
All
TV.
right, that's why I asked. Actually, one more. And do you think physical therapists should give a damn about Jane's new AI scribe?
Absolutely, especially if you're self-employed. Like that's it's from like the feedback that we get. That's why we have them as a partner on FitBux and that we help promote them is because the cost of it, the ability, the time saving aspect of it is massive,
Yeah,
massive, massive, massive. The scribe component of it is,
it's a game
I mean,
changer for me.
I can't tell you. I mean, you guys are PT, so I know this, but like just taking notes. Everybody complains about taking notes. Like the AI scribe piece is so awesome. It
Yeah,
just saves so much time.
I know. And
Um,
it's accurate and you don't have to sit there taking notes, or I love it because I don't have to remember everything that I do during the session because it's transcribing it as I go along. So that's why I love it.
exactly.
So I think we're in agreement on this one. Maybe not
Yeah,
Taylor Swift and Love Island, but physical therapists should definitely give a damn about Jane's new AI scribe. And if you want to find more info about Jane, we both have Jane codes that you can use if you want a free month. Mine is Litzy1MO. What's yours?
FitBux. Yep.
Perfect.
FITBUX.
Perfect. So use either one of those. If you go down to the show notes of today's of this episode, whatever you're listening on, whatever platform, you'll find all the links to FitBux and you'll find all the links to Jane as well.
Yeah.
So, Joe, thank you so much for coming on. This was a great conversation, and I know that you have helped a lot of people with this conversation. So, thank you.
Yeah. Thanks for having me and thanks for stumping me on the pop culture questions. Appreciate it. So,
Anytime, anytime. And everyone, thanks so much for tuning in. Have a great couple of days and stay healthy, wealthy, and smart.